Return of capital occurs when an investor receives a portion of their original investment that is not considered income. So many of the funds that I own and preach about on this channel, like income funds, split funds, covered call ETFs, and even REITs, can classify a portion of their dividend that they give out as return of capital, or RoC. It can be a small portion, it could be a big portion. It really varies from fund to fund. And I'm getting more and more questions about this because many of you are afraid and have very negative thoughts about RoC income in general. People think that it's simply your own money being returned to you, kind of like a Ponzi scheme, and that these dividends are really eroding the fund's NAV or simply the overall value of the fund. Some people even think that funds that give out a really high percentage of RoC income year after year after year will basically drive the stock price to zero. So technically, like the definition says, RoC income is indeed a portion of your money coming back to you, but it's a little bit more complicated than that once you dig deep. So in this video, I want to share with you what I discovered about RoC income in general, what my point of view is on it. Trust me, I had the same concerns you did because I'm not an accountant and taxes are not really my specialty whatsoever. And I always like to know everything about the funds that I invest in. So the reality is that RoC is like cholesterol. There's good cholesterol and there's bad cholesterol. So let me explain. So first of all, it's important to understand that RoC, or return of capital, is one out of the 4 tax classifications that investment income can fall under. So there's interest, right? There's dividends, there's capital gains, and then there's RoC. Out of the 4, RoC income is taxed the least at $0. And this makes complete sense because, like the definition says, it's a portion of your capital or your original capital being returned to you, which is another way of saying that it's a portion of your original investment returned to you. So of course it's not taxed, it's not considered income on paper. So what does RoC income actually do to your investment? Well, it lowers your adjusted cost base, or your ACB. So if ever you want to sell the stock or fund in the future, you need to ensure you factor that in. Let's take an easy example so I could show you what I mean. Let's say you invest in stock ABC at $10 a share, and let's say it has an annual dividend of $1.20 a share, or 10 cents a month. Also, let's assume that all the dividends are classified as 100% return of capital. So that whole $1.20 that you got for the year, return of capital. Let's say you want to sell the fund now after a year of collecting the dividends, and the stock price of the fund is still $10, the exact price you bought it at. You might think, well, I broke even, so no capital gains to pay, right? Wrong, because your ACB, or your adjusted cost base, is no longer $10. It's $10 minus $1.20, or the dividends you got within the year. So it's $8.80, which means if you sell it, you need to pay capital gains because it's as if you bought the stock at $8.80 and sold it at $10. So it's as simple as that. Another thing I want to point out is that many funds give out RoC income, not only closed-end funds, which I usually refer to as simply income funds, but also covered call ETFs, which make their money with 1, dividend income, and 2, option premiums. But also REITs, they could also give out a portion of their income as RoC. I bet you didn't know that. So you might be asking, where do I get this information? How do I know what's considered RoC or not? Well, there's 2 ways really. You can see the breakdown on your T3 slip for every investment you have. It's specifically in box 42. Let me show you a quick example. So here's a random T3, which I took a snapshot of and just erased my personal information. So as you could see, this is for B2B REIT. So this is a REIT. And as you could see, in 2019, I got $220 of income from this REIT. And as you could see here, right next to it, box 42. So when it says box 42, it means that the income, or the $220, is classified as RoC income. So whenever you get your T3 statements for every single investment you have, if you see box 42, well, this amount is your RoC income. So another way, and this is the way I prefer because you could easily go back a couple of years, is simply to go on the fund's website and look for the income breakdown of their dividend or their distribution. It's really not hard to find, and it's usually under something like tax documents or their financial report section. So let me show you real quick what I'm talking about here so we could see a few examples together. Let's start with one of my favorite covered call ETFs of all time. I always talk about this one, ZWC, the BMO Canadian high dividend covered call ETF. So if you go on here, tax and distributions, and go to 2019. I'm going to 2019 and not 2020 because the numbers are not in yet for 2020. So 2019, that's it. If you go all the way down, you could actually see the breakdown of the distribution. So as you could see, the total distribution, 1.31, $1.31. 0.64 of it was eligible dividends, no capital gains, as you could see, and the rest is return of capital. So here's a great example. If we just go back to 2018, we'll see the breakdown here. So once again, eligible dividends, a little bit of capital gain this time, but a lot of return of capital, which make up the dividend of $1.23 for that year. So let's move on to a REIT. True North Commercial REIT, one of my favorite REITs in Canada. So if you go to investor distributions, you will actually see this here, 2019 statement of trust income and allocation. So if you open it up, you will get this Excel file, which just shows you, basically, it's not really hard to understand once you look at it, the classification of the dividend. So you could see here total income per unit. So this is the distribution one, so the first month, the second month, and as you can see, this is the dividend. And you see here box 42, return of capital. So you could see here that basically True North Commercial REIT, for the whole year of 2019, their dividend was 100% return of capital. Here's 2018. 100% return of capital. 2017, 100% return of capital. Same thing for 16, same thing for 2015. So that means in the last 5 years, True North Commercial REIT has given all their dividends out as return of capital. Another example, one of my favorite income funds is the Canoe EIT income fund. So if you go to tax information here on their page, you could see 2019 distribution breakdown, percentage of distribution. 88% of it is return of capital. If we go back a few years, 2018, 46% is return of capital. 2017, 48.5 return of capital. 2016, 38%. So as you could see, a really big portion of it is return of capital. So as you could see, many funds, even REITs, give out a portion of their distribution as RoC, some a really high portion, even 100%. So this can be a bit confusing, right? How the heck are covered call ETFs and REITs giving out such a high percent of their income in RoC? Does that mean that they make no real money? Well, I asked myself the same question. Covered call ETF income in particular has baffled me because call option income, as we all know, is classified as capital gains. But some ETFs, like I own, for example, ZWC, or even QILD, the ETF I covered in my latest video, give out a lot of RoC income, but no capital gains. How is this possible? So I started researching, and when I can't find what I'm really looking for online, who better to email than my friends at Harvest Portfolios, one of my favorite ETF managers. I've emailed them in the past, and they've been very quick to answer any of my emails or concerns that I had about their funds, which most of which are covered call ETFs. So I figured I'd give them a try, and as usual, they replied very quickly and referred me to an article they had on their website. And after reading it, I was finally able to understand what's really going on. So let's check out this article real quick. All right, so if you go on Harvest website and go to learn covered call strategies, tax efficient cash flow, this is the article you're going to see published not too long ago. I strongly suggest you read the whole article. It not only explains RoC income, but also general stuff about covered call ETFs. So it's basically a Q&A type of article. And the question that we're interested in is this one right here. Can you explain how your tax factors for distributions have been treated as RoC, or return of capital? And are you just giving me my money back, or grinding or eroding the net asset value of the fund? So here is the $1 million question, right? So they answer it by actually giving 3 examples. So let's go through the examples together. So let's say you have an ETF with a NAV of $10, And during the year, it generates $1 in option premium. So this is the income from the covered calls, right? This $1 is paid over the course of the year as a distribution. That's right. And the investor would receive the $1 of cash flow during the year, and on their tax receipt, it would be treated as capital gain. This makes sense because covered call income is considered capital gain. So the NAV would stay at $10. So this is the general, normal scenario. Let's look at scenario number 2. Let's say an ETF has a NAV of $10 and no option premium was generated. So they didn't sell any covered calls for that year, but they still paid out a $1 distribution. So you're still getting your dividend. Well, of course, the investor, which is us, would receive $1 of cash flow during the year as a distribution, but on our tax receipt, it would be treated as return of capital. And the NAV would not be $10 anymore. It would be $9 because they didn't make any money. They didn't generate any covered calls. So of course, if they pay out $1, the net asset value will be grinded down to $9. So this RoC is not just RoC from a tax perspective, but it's encroachment of capital. It's really actually just getting your money back at the expense of a decline in the NAV. So this is what is referred to as grinding. So this is the negative or the bad scenario, right? That everyone thinks as soon as they see RoC income, they think of this scenario. Well, there's a third scenario, guys, and here is the key. Let's say an ETF has a NAV of $10 and generates the same thing, $1 in option premium or covered call income for the year, and pays the $1 in distributions to us during the year. Well, if the ETF had tax loss carry forwards or has realized losses during the year, then for tax purposes, that could be applied to the capital gain, and the $1 would be treated as return of capital. So the amount of return of capital reduces the adjusted cost base of the units held. Yeah, I already explained that at the earlier in the video, but basically what's this saying is that although the ETF is generating the money, the dividend with the covered calls or option premiums, if they had losses in the past, don't forget losses could be carried forward indefinitely. It could be applied to the capital gain, and that $1 would be treated as return of capital. So there you go. So although I can't say I fully understand all the intricate details of RoC income and the taxation behind it, I think I get the gist of it. What I understood is that fund managers can use carry forward losses. Don't forget that losses can be carried forward indefinitely to offset the capital gains and turn the income into RoC income, which is much more tax efficient for us. The main takeaway for me is that RoC income is not necessarily a bad thing. On the contrary, it helps us pay less taxes on our investment income. I see it more like a tax advantage that these funds provide us. Don't forget that the people managing these ETFs, split funds, income funds, and REITs are professionals. They know accounting and taxes much better than you and me, and can use various techniques unknown to most of us to make their distributions as tax efficient as possible. And what's more tax efficient than RoC income? Nothing, right? Because it's not taxed at all. So of course, if you hold these funds in a TFSA or RRSP, you don't really care about that because it's all tax-free anyways, no matter what the income is classified under. But in a regular cash account, this can save you money on taxes. So do you really think that a covered call ETF or a REIT or an income fund that gives out a really high percentage of RoC income will eventually go to zero? Well, let's check out the last 5 years of the 3 examples that we looked at, starting with ZWC. So as you can see here, the last 5 years I'm looking at pretty, stable, up and down a little bit, but nothing crazy. COVID-19 crash right here, and now a COVID-19 recovery. And why hasn't it recovered back to its normal level? Well, because this is a covered call ETF. Don't forget that with covered call ETFs, you are sacrificing a little bit of stock price upside to get more income. What about True North? Remember that REIT that we saw that the last 5 years gave 100% RoC income? Well, here's the last 5 years of the stock. It doesn't look like it's just going down and down and down to zero if you ask me. I see that it's actually going up pretty hard. Right before COVID, then bang, COVID-19 market crash, and now it's recovering. What about EIT Income Fund? Same story, guys. Last 5 years, very stable. COVID-19 market crash, and now COVID-19 recovery. So by looking at these charts, it's just proof that even though a lot of these funds have a lot of RoC income, it doesn't mean that the NAV or the stock price will eventually go down to zero. It just does not make any sense if you ask me. So here is the main takeaway as I see it. As long as the fund can keep generating income, you're fine. That's really the bottom line. And since a dividend income, covered call option income, and rental income for the REITs is pretty much infinite, we have nothing to worry about. Now, can there be funds that give out too much RoC income? The answer is yes. It's simply because the fund is not generating enough income over the years. Many factors can contribute to this, like poor management, crappy stock selection, bad dividend policies, etc., etc. This is why I always tell you guys, look inside the ETFs, the split funds, the income funds that you own, to actually look at the stocks in the fund. You also should look at the price, the stock price history, the dividend history, and the dividend policy. Is it all sustainable? So once you do that research, then you could decide whether or not you feel that the fund is right for you or not. You want the ultimate proof that RoC income is not necessarily bad? Well, remember what I explained earlier about RoC income lowering your adjusted cost base or your ACB? Well, if you actually hold a fund long enough that gives a lot of RoC income, you could actually get your ACB to zero. Think about it. Not only is this possible, but it's pretty much inevitable if you're a long-term buy and hold investor like myself. It can take a really long time. It could take 10 years or 8 years or 15 years, but it will happen eventually if you just hold on to it and the fund keeps giving RoC income. So what happens to your next dividend that you get that's classified as RoC once your ACB hits zero? Will you never pay any taxes ever on the RoC income you get going forward? The answer is I wish, and unfortunately, no. Once your ACB hits zero, all the income you get from the stock will be classified as capital gains, even if it's technically RoC income. As simple as that. But hey, capital gains is actually the second best tax efficient source of income after RoC. It's taxed better than eligible dividends, so not a bad deal if you think about it. So the overall lesson, guys, in my opinion, don't let RoC income scare you, worry you, or worse, prevent you from investing in some really lucrative funds managed by really good fund managers that can provide you passive income forever. Consider it simply as a tax-efficient distribution, just another bonus for being a passive, buy and hold, income-focused investor. So I hope this was insightful for you. Please support me and my channel by hitting that like button. It's free and it helps the channel out tremendously, so it's a win-win. And finally, make sure you're subscribed so you don't miss out on my future content and community posts on passive income investing, which is all designed to really help you on your investing journey. We're also on Instagram, so if you use it, follow us for even more content. My mission remains the same, guys. It's to help everyday working Canadians invest on their own to build up their own stream of passive income and enhance their quality of life. So with that, take care, guys, stay safe, and see you next time.